They
right?
have no idea what's going to
Yeah,
happen in 2 months. That's why they
no.
didn't want the market to get too excited because they don't even know what's going to happen. What the market is able to do between now and when I think the wheels might actually come off the bus, depending on how high it's able to get, plays a big factor on whether or not it threatens like a complete collapse of market structure on whatever kind of downturn we have. Hey man, how are you?
TXMC. Let's take a look at this. And this is a chart of the DXY. I have it zoomed out a little far. I have it zoomed out to really like the last time we saw the dollar liquidity crisis taking place, and we saw that milkshake really like textbook, right? And then over here we all know that like the Fed intervened massively, offering opening up direct swamp lines, and then as well as expanding the balance sheet by 4.1 trillion, and then a massive QE program of another 1.2, 1.4 trillion dollars for the next couple of years. And we saw the dollar come off, and I mean, we're seeing that dollar milkshake playing out once again. There's,
Yeah.
very strongly, and I want to just come back over to this place over here, right? And that is October 16th, 2021. We're looking now at a little less than a year's time. And this was a significant event for myself and for the markets. It was the Fed meeting minutes. And they were pretty clear that they were going to be tapering their QE purchases. I think this is something that I myself was able to recognize, but I don't think that I executed well at all. And that's what I want to talk about. And then I want to talk about how I could have personally executed much better. I want to see how that lines up for you. And then I want to see if we could go ahead and talk about the current macro situation, Fed policy, talk about the current energy crisis taking place, and see if that maybe together in light of what we talk about now, maybe we could figure out something that might be beneficial going forward. So at this point in time, I know that it was very clear that the Fed planned on tapering. And then if they were able to wind down their purchases by March, then lift off and begin raising rates. And a lot of people at this time in the space were pretty much under the impression that the Fed couldn't taper a Ponzi, nevertheless raise rates. But there were people out there who affirmed that for sure, whether you're talking about like Luke or Lynn, that they could actually taper and tighten. And I think at this point in time that probably I should have been talking a lot more about how risk assets were going to come under pressure, and Bitcoin was not immune. And then giving it some time, because we didn't know what was going to happen between here and March, and whether or not they were going to actually be able to wind down the taper. But at this point in time in March, where we had the first rate hike, I think that I think it should have been a pretty easy trade, seeing the divergence in central bank policy between the Federal Reserve and the easing going on in the Bank of Japan and also at the ECB. That for me personally, I think that I should have, forget like, all right, maybe for anyone who wanted to lighten up on their Bitcoin exposure and or begin building dollar reserves, better than building dollar reserves would have been having that dollar account, that dollar positioning, and taking positions against the Japanese yen and the euro. And just a quick view during that time period of what we've seen, when right over here the Fed begins raising rates, and we see 25% move in the currency markets is enormous. And then also the same thing occurring on the euro. And if you take a quick look at the euro US dollar from around that time also, it was very clear. And again, I didn't do that. And looking back, I think that it's very clear to me that it was almost like a layup. I should have seen that, and at that point in time, right now, that would have really put me in a position of power, in so much as that not only am I positioned appropriately, at the same time you're collecting a nice swamp, a nice interest on both the euro and the Japanese yen, and then that affords for the possibilities of maybe even dollar cost averaging into Bitcoin over this time, or a lot of other options. So does that make sense in hindsight, looking back and saying what really would have been a much better way to position?
It does make sense. Particularly when you look at the yen, I think it was pretty obvious, right? It starts basically on the day that the tightening actually began. So that I think that's a really obvious trade now in hindsight. Not something I had certainly in my mind. I've never really traded forex, but it seems like these kind of environments are unique opportunities where if you can, recognize what's about to happen, you can set yourself up pretty well. In hindsight, this looks like it would have been a really nice move.
Yeah, in hindsight's always a lot easier, but at the same time, it really helps us going forward if we pay attention to what we did well, but specifically what we didn't execute well on. And I get that a lot of people don't have experience in the foreign exchange markets, but we are seeing Bitcoiners really branch out and becoming legit macro informed, and right now we're all focused on the energy crisis taking place and these geopolitical events, and that all comes back to and look, at the end of the day, we're all here to try to maneuver in the markets, and foreign exchange plays a very important role in that. And
and a 25% move is a gigantic move in forex.
It's enormous. It doesn't happen. Yeah, absolutely gigantic. I'm glad you can look at this chart and be involved in the cryptocurrency markets, and you'd be like, oh, that's not really, I see those type of moves all the time, but these markets are traded with leverage. In the US, 1 to 50, and then 1 to 200 elsewhere. A small move is quite significant. So we're looking right now at the world, and I know we spend a lot of time on current Fed policy, and I think it's important to just kind of review quickly together where we currently are. If you could give us a bit of a background as far as the tensions that we're experiencing right now.
Yes. Wow. And that, as you were talking through this, you got my mind really working through like where my head was at in like October, November of last year, how I got things wrong. There's certainly a lot of learnings for me. I've learned a lot as a market participant in the last calendar year in particular, since last fall, since we were at the all-time high for Bitcoin. One thing that I got wrong that I do want to say, when I was observing the markets in October, November, I was still heavily looking at on chain as like my foundation for observing Bitcoin. And I made a lot of observations back then about how quiet the market was, about how low the activity was on chain, about how there was a clear kind of underlying bearish divergence despite the fact that we've made an all-time high. And when I go back and I look at those tweets, like it almost seems obvious that it was about to be a rollover in the asset. But for some reason, I was seduced a little bit by those kind of narratives that can take hold in a bull market, and almost convinced that like it was a new paradigm, that we were going to enter some new hodler-driven bull market where there was very little activity on chain, but yet somehow that would drive price higher. But which now, as I'm describing it, doesn't make sense to me at all. But I was seduced again, a calendar year ago into thinking that we were just going to continue going on, even though the data was clearly telling me that we weren't. And I think that's a learning for me, certainly, but it can happen to anyone, really. That if the data is telling you something, but your mind is convinced of a certain narrative, you might not see it. So that's something that I've really kind of been, I don't want to say grappling with, but it's a big learning for me over the last 9 months or so, is being more attuned to what the data is telling me and less what I think should be happening.
Yeah, I think we were all seduced. It was almost as if like $100,000 Bitcoin was almost like a given.
Yeah, I saw a tweet of yours maybe yesterday or a couple days ago that maybe we can get into at some point in this chat, about how you you acknowledged, or you recognize, I can't remember your wording, that the structural top of the market was actually the first half of last year and not the second half of last year, which aligns with an analysis that I've done regarding like on-chain activity. So maybe we can talk about that at some point. But I know you asked me a question a minute
That's exactly
ago.
where I was going. That's exactly what I was going to talk about. In April and May of 2021, it was so apparent what we were seeing, whether you're looking at a traditional indicator like relative strength, the RSI, whether you were looking at everything taking place on chain, whether you were looking at the euphoria taking place, not only in the NFT market, but Elon Musk going on Saturday Night Live to
Right.
pump Dogecoin. I mean,
That was
all
literally the top of Doge.
the very top. And I had a friend call me the day before, and he's like, Jordan, I finally got in. I'm like, for years, close friend. Oh, you finally bought Bitcoin? No, I bought Dogecoin. And that should have been a sign also. I don't think that a lot of us or many of us were looking for shortening cycles, right? Many people were looking for something like maybe lengthening cycles, or even, super cycles and stuff like that. But all of us, I think, were looking for significantly higher prices. And then I think that didn't allow us at that particular time to really recognize what was taking place.
Mm-hmm.
And then in the summer, there was a bit of, for a lot of people, a lot of uncertainty, a bit of a scare. And as that price in the fall started rising and almost willed itself to new all-time highs, because you were saying that on chain, you weren't seeing the same signals that you saw back in the, right?
Right. It was clearly weaker. And really all of the like monumental like ceiling of activity really came in like January, February, not even where the actual high for price was, but really that first break over 40,000 and then the pullback in January before we got the Elon candle, before we found out that Tesla had Bitcoin on the balance sheet, that like just kind of natural, which was really driven in a large part by the grayscale arbitrage.
Right.
That first blowout was really, if you think about it, that was kind of like a blow off market peak. If you look at on-chain transaction volumes, active addresses, transaction counts, any of those kind of things, that's where they peaked. That's where the peak of volume was on Coinbase. That was the high for RSI on almost every time frame, like from a day all the way up to a year or a month, I think, 3 months. It doesn't matter. All the time frames, that was the high for RSI. And we set a high in price, obviously, a couple of months later.
Mm-hmm.
And my analysis of that was I really believe when the grayscale arbitrage kind of faded away in February, when the premium on it went negative, then what we really were carried by was a lot of derivatives activity, a lot of people going 100x long, to the long and the short side. Actually 100x leverage. And you can see it in some of the derivatives things. If you look at the funding rate and some of that data, you can really see how volatile that market was. And it helped produce that kind of Bart Simpson top. But that was occurring while the underlying spot activity was kind of melting away. So we just had this crust of derivatives activity holding up price. And as soon as that broke in mid-May, there was nothing underneath it to support price at that point.
And obviously our focus so much on the Bitcoin market. This type of behavior was also taking place, in the public markets and in the US stock market. This is when you were seeing the meme stocks really exploding and running. I mean, the signs of speculation peaked, right? Yeah. And also that's when the Chinese stock market, the Hang Seng peaked as well. And I know that, well, foreign exchange, the Chinese stock market, but we're living in a world where all these things are related. I know that it wasn't on my radar at the time, but it's really helpful in trying to make sure that I improve my skill set each and every day, so long as I've been in the markets, right? That, in the next time around, I want to make sure that I'm aware of everything I should be aware of. And that includes right now. Because if you go back to what we were talking about, and whether it was October 2021, and there were very few people, just I'm using broad strokes here, but there were very few people who were like, well, the Fed's pivoting here and this is not going to be good for risk assets and that you should get into cash to protect yourself. I mean, I'm
Right.
sure there was someone out there. I just don't know how long that person was on the right side up until that point. But as far as like the general, everyone, when I say everyone, all of us pretty much, in March and April 2020, were like, this is going to be uber asset inflationary and this is going to cause inflation. And there were some, macro experts out there who, have a much longer, let's say, experience, whether it's like Dr. Lacey Hunt, who was unsure whether or not we were going to see these deflationary forces. But, as far as all of us, I mean, like crypto Twitter and everyone was pretty much on the same page and on the right side. And I don't think that was the same case when we came into October, November of 2021.
No.
I feel like we were all on the wrong side, as far as a couple of people mentioned it, but no one really was like, listen, this is going to be really bad for risk assets. The Fed is going to be tightening, and now is the time to protect yourself. And so that makes me think right now, well, a lot of us are under the impression that, well, inflation's obviously rampant and the Fed is going to continue tightening in an attempt to do whatever it could do to control that and bring down inflation, whether that's through just slowing down the economy or causing a recession or something worse. And I'm making the assumption that's pretty much the general consensus right now.
I think it is. And partially because the Fed has tried to convince the market that that's what they should believe. And any time that they have felt that they've given the wrong message, they have been very quick to try to dispel the market of any belief that they're going to do something other than tighten us into the ground.
They've been very clear in their communication.
They have, and it's been extremely effective. Granted, they have raised the terminal rate 225 bips in like a 6-month period, which is a crazy pace considering we were basically at the zero bound. But the majority of the market did the work for them. I would say they did 80-90% of it in response to their pulpit use. The forward guidance tool has been the most powerful tool for the Fed, no doubt. And I think
that's what they wanted. And when I say I think that's what they wanted, because the Fed can only raise rates so far without it affecting its debt obligations, and that's just also a fact. So
it is, and that's something that I've been trying to study quite a bit, and there is no way to like pinpoint the answer as to how much tightening the economy will endure, or at least the federal government can endure, before it then has to monetize its debt obligations, because the money has to come from somewhere. And at some point austerity measures have an impact on tax receipts, even though they just had a huge windfall of taxes. They had a huge swell of tax receipts because of what happened last year. That will melt away at some point. And so I don't know. I don't know at what point we reach, because when you look at the debt obligation, when you look at the cost of it, 2022 has been the most expensive year on record for this point in the fiscal year. And that money must come from somewhere. And I don't know where it's going to come from.
Interesting. And that's something that, for example, like Luke Gromen is really honing in on, right? And that's a very important piece of all this. It's almost as if, well, this year the government was able to take in a lot of tax revenue, but what about next year?
And they cut their spending as well. They cut the fiscal spending at the same time as they pulled in all these tax receipts. The Yellen has been helping with that. I don't remember all the line items, but I was reading a story about it in the Wall Street Journal a couple weeks ago. And so to your point, they're trying to make it through this year, I think, and try to keep this going as long as they can and hope things get better before they have to change their policies.
Now, one of the confusing pieces is that the Fed has been so clear in their communication ever since, that October meeting where it was very clear they were going to taper and look to raise rates. And then since with like, no, we are going to continue tightening. Inflation's a problem. We need to bring it down. It's been very effective. But prior to that, they were on the wrong side telling us inflation was transitory.
Yeah.
So it was almost as if like, well, how do we know to believe them now? Right. Because it's so recent. It was so recently that they were telling us something that we just knew wasn't true. And they didn't really admit it until it was out of control. And so right now, when they say that they're going to, continue tighten and they need to bring in it, how do we know? Like, well, the communication's been clear, but how do we know? There is that almost like uncertainty, at least for myself, there's that uncertainty. Yeah. And also knowing that Fed's projections have never really come to fruition, whether or not you're talking about the last QT program and how long it was expected to go. Neither the Federal Reserve's expectations or any investment banks came remotely close to what happened in reality. And
if you look at every model of inflation, every single projected model of inflation, they all obediently trail back down to 2% after like a calendar year, regardless of how bad CPI gets in any of these models. They all just kind of obediently fall back down to 2% because that's what the Fed wants it to be. And so the assumption is that whatever they do will get us there. And I think it shows a remarkable lack of history in how inaccurate they have been at achieving a lot of their targets throughout the years. And to your point about believing them, I think it was in 2019 when Powell pivoted. I believe just weeks before that, he was still talking about the desire to continue raising interest rates. And so like whatever they say, right.
The market rallied before the Fed pivoted by 2 or 3 weeks.
I would say the bond market leads the Fed in most instances. It gives them room to operate. It lets them know when they can't go any further. And for part of this year, it seemed like the bond market just didn't believe them, kind of to your point. Like it seemed that they couldn't price themselves at the interest rate the Fed said they were going to go to. Like if you just looked, I mean, recently we've seen the 2-year breaking out again, but for a couple of months there, it was kind of stuck at like 3%, 3.1%, even though the Fed is screaming about 3.5%, 3.8%, 4% rates. The bond market just couldn't get there. It hasn't been able to take that in as like a realistic scenario. But just recently, we're starting to see the 2-year tick up just a little bit more. Maybe they are starting to believe the Fed. Whether they're wrong or right, I don't know. But it does seem like maybe the bond market is giving them a little more runway. Would you agree?
Yeah, I mean, so you probably by now have seen that tight correlation between the US dollar, Japanese yen, and the 10-year. And around that time that Powell came out in the last press conference and he was talking about, being close to achieving neutral rate and yeah. It was perceived as dovish. And I noticed
I didn't believe that.
You didn't believe it, huh?
No. Mm-mm. Go ahead. Sorry, I didn't want to cut you off.
What I think happened was I think that I did believe him. But I think what happened is the market so instantly began front running. And you saw yields coming down. You saw Japanese yen going bid. And a lot of people who were kind of like taking that trade against the Bank of Japan, they were like, well, let's, reposition ourselves. And then the Fed speakers, here's the problem is the market begins positioning so quickly now. That we were talking about those tools that was largely coming from that verbal intervention. And in a very short time frame, within a couple of weeks, that was all undone. And then you saw the Fed speakers get out there and make sure before Jackson Hole to quickly reframe that and talk it back. And then Powell and Jackson Hole, affirming that stance, it got us back to almost right where we were. Right. And I think that's where they want to be. I don't think that they like that the market positioned so quickly and so strongly and they had to talk it back. So,
that's an interesting way of framing it. And I think I pretty much agree. I think you're right about what Powell said. Like maybe he actually believes that they were closer to neutral than they've now had to say, but I think the market's reaction is what caused them to kind of be surprised, because it was a crazy pump. That was a really violent bear market rally that we experienced for about 4 weeks there. So 4 or 5 weeks. And I went on, I have on my YouTube channel, I told my audience after that FOMC in July, that I think the market has this dead wrong. And the reason I thought that they had it wrong was not because I necessarily don't believe Powell, but I think the market heard the neutral comment and ignored everything else that he said in the same press conference, where he said, listen, guys, tightening works on a lag. We've just done a whole lot in a very short amount of time, and it hasn't all been digested yet. The rat is still at the front of the snake, and it hasn't moved its way through the body yet. And that will happen over the next few months. And for some reason, the market kind of ignored that piece. And that was the crux of my thesis on that. And then what do you know? All the Fed governors come out and they say, hey, whoa, guys, you're way overreacting here. That's not what we meant. And then you get the 8-minute Powell speech at Jackson Hole. So you're right, though. I think the thinness of the market is contributing to how quickly it's capable of moving, because there's not a lot of friction there that you would normally have if it were deeper. And so that might be part of it.
Yeah, I mean, and again, that's the way that you viewed it was bang on. You were absolutely correct, and the Fed made sure that we all understood that very quickly, right? By like, well, we got to almost regain all these gains of tightening that we had in place, and which got away from us too quickly. And I do think that right now we are truly in a data dependent market. And what I personally mean by that, I do think that the upcoming CPI print, whether or not that it's, winds up being over 8.5% or under 8.5% last month's print, and by how much in either direction, you will see right after that print quickly the odds of a 75 basis point hike or a 50 basis point hike priced into the markets. You will see a big reaction accordingly in the markets around that time. And I do think that depending on what that print is, will be how the Fed moves at the end of the month. So, when you briefly mentioned that usually, or in the past, all these models price in within a year, you look at inflation returning to 2%, but it's also tracked year over year. So we know we're never going to see prices come back down.
Right.
But it is possible, I don't know how far, how many months ahead from now, but that soon we start seeing, inflation year over year. We're not seeing like 8.5%, percent prints anymore, but something closer to 4 or 5 would be something that I do expect, but it could even be lower. And it's almost like a little bit of cheating taking place.
Yeah, the way we measure it is a trick in a lot of ways, because when inflation is low, it's still a positive rate of change, right? Prices are kind of just always going up. And because it's a year over year comparison, the CPI print this past month was flat. It basically didn't change. If you look at the actual index, not on the year over year, but just the aggregate index, just went sideways for a month, right? Because prices, the basket didn't change. And if it stayed like that from now to December, the Christmas CPI print would still be 6.3%, because prices right now are up 6% from December of last year. Okay. So if we had zero price changes through the end of the year, the last CPI print of the year would still be over 6%. So we would need to get actual deflation sometime in 2022, prices actually falling, in order, and not just energy, it would need to happen across the basket, in order for us to see a lower than 6.3 or so CPI print come December. Now that you could carry that trend forward into the spring, and it would be 5% or so in February. Okay. So we would need to see significant
what would it be, March, when you would see it really fall off and come down? Because
it would probably be March or April, and even still then it would. I haven't carried my model that far forward. I probably should, but I believe that it would be around 4.5% in like March, and so that's still well above their target. And then that assumes nothing else changes, right? That's just a vacuum of CPI from now for the next 6 months.
And
So
things
I don't
could
know how
change
likely
pretty
that is.
quickly because, you could take it, just very simple view and look at the price of crude oil,
Right.
and which also I would say that that's been a pretty good barometer, in so much as that when the market rallied in June, end of June through July, you didn't see crude actually rallying. It kind of
Correct.
held its low. So I would say that was actually probably one of the better barometers, not buying in for that. But a lot of people are really focused in on the supply side of that market, and the
Yeah.
paper price doesn't seem to align. And I don't think that anyone would be surprised if in several weeks at any given time you saw crude trading back above 120, and then you wouldn't be seeing month over month, forget year over year, the headline inflation coming off. It would actually be rising again. And so we
Yeah.
are in a data dependent market. Things could go either way and very quickly.
We are, and there's other aspects of what goes into CPI that haven't begun to soften in the way that the oil price has. Like to your point, I mean, it's kind of been staying around $85-$90. The rate of change isn't going up anymore, but it's stubbornly kind of hanging out there. And I think some of the supply side problems will cause it to spike, numerous times over the next year. We're certainly not out of the woods there. And oil, like most commodities, is really volatile. It tends not to go to a plateau. It shoots up and crashes and shoots up and crashes, and it can worm its way to a higher level, but it's hard for it to just kind of stay up there. But some of the other aspects of CPI, like if you look at food, which is the second most volatile piece next to energy, just CPI for food, the index of it on year-over-year basis is still pointing up. It's like at 10%. Food prices are up 10% year over year. Protein rich foods, which are like the most important ones, meat, poultry, fish, and eggs, those are up like 10.5%. And those are both extremely high, like relative to their histories. And those haven't begun to soften. Like, so food hasn't even made a lower CPI print yet. And it's the second most volatile piece of the basket. Same thing with rent. Rent follows home valuations, right? And it usually follows it on a lag because leases are not signed in real time. They're usually signed like once every year, 18 months. So rent follows home prices on a lag. Well, home prices are up significantly year over year, and they've been doing that quarter on quarter for like the last 6 quarters. So we're starting to see rent creep up. And now rent almost never goes down on a national basis. It kind of always is perpetually going up. But because of the rapid rise in home valuations, and because rent on a rate of change basis doesn't usually slow down until home valuations start falling on an annualized basis, and we haven't seen that yet. There's not a lot of evidence to say that rent is going to slow down anytime soon until we see homes significantly stall out. And so that's another kind of tailwind on the CPI that will keep it from just falling as we would like it to, and as the models suggest that it might.
So that's really interesting. You just kind of segued into the next little piece that I would like to talk about. But, one thing that I noticed when you're speaking is that almost that me and yourself are living in almost two different time frames, in so much as you are focused in that bigger picture year over year, and appropriately so. Like, look, even if we're talking about prices leveling off, they're still significantly higher than they were a year ago or 2 years ago, and that's not coming back in. I don't think that's coming back down or in. And
I
I'm
don't think so.
also looking at over the last, let's call it 30 to 90 days, and in why year over year food prices are up significantly. They are over the last 60 days, off almost in proportion to the price of oil. So, this month's CPI, I expect actually to get like a gimme, like a really nice print. I have no idea what happens into the fall and into the winter.
I think you're right.
And it could, as we were hitting like in June, that crest, that's when a lot of people were like, commodities, oh, that's the trade. And if we look at what's taking place with this like new world order shaping up and the role commodities are going to play, And like, it was almost like at that particular point, that's when a lot of people's attention were drawn to it. And, so you want to get the bigger current, the bigger picture. And that is, and I think that if we look at, well, how can we position ourselves for the future? I think we need to look at how commodities play a role in that. And that's not an easy answer. I'm still shell shocked from when you looked at, the June forward contract of WTI crude oil trading negative, right? So like that would prevent me personally from ever taking a big position. I can't store physical crude at my house. It's just not possible. Right?
Exactly. I
don't have
can't
any
take
container
delivery.
ships, So like that right there, that's got me. So, but there's got to be a way or that you could execute in commodities and but the timing was not kind of as everyone gravitated towards it. And it's like things work in waves. And right now, like we're seeing the crest come down, and we don't know if it comes crashing down and for several months, or if all of a sudden by the late fall, it's going shooting back up higher. But
Yeah.
you want to get that timing into the next wave as well as could be expected, right? And I think that's where we are right now. We don't know what happens next. We are slightly rolling over. Like we're looking at a big set coming in, a big massive wave, but that wave has just peaked, and it seems to have peaked for the near term or maybe intermediate term around the middle of June, right? And now it's a question of, does it continue to come off a little bit? I expect eventually it comes up much higher, and the next wave is bigger than that first wave, and
it could.
Yeah.
And when you look at like CPI back in the 70s, which is the closest analog we have to this kind of commodity shock, it went up really significantly, and then it came way back down over the period of a year. Like it fell by like 2/3 of its initial rate of change. And then it went on to set a new high, and then it came all the way back down almost to the same low that it set in the previous valley, but not quite. And then it made another high, and it made these like 3 peaks. So we could have, a series of months where the rate of change of inflation is softening month on month, compared to the year prior. And what that does to assets, I think, is anyone's guess, but it certainly might not necessarily mean we're out of the woods, but it could provide opportunities for the market to kind of oscillate through this saga rather than just going straight into the ground like some people think it's going to.
It's interesting. Around that time, we saw the Fed with the Fed funds rate going up and down, up and down, up and down. And, why the most recent cycles have been like rate hikes, pause, rate decreases. I think, I know the Fed is kind of with that verbal intervention is we don't want to be doing that, but I would be surprised if it didn't go along that direction. And the Fed is kind of playing like whack-a-mole and having to raise rates, lower them, raise them again. And that might be what we're looking at in the years ahead. I mean, again, we're data dependent. It's hard to make those type of assumptions. And
yeah, and they're just as data dependent as we are, like they don't necessarily know any better information about the crop quality upcoming for this harvest than we do necessarily, like things along those lines that could cause it to spike again. I think your base case, if that is your base case, is probably aligned with mine, that we're going to have just these kind of sagas for the next few years because they're not really doing a lot to solve the underlying problems that are causing the inflation on the supply side. And anytime we get a demand return for any reason, it's just going to cause those things to spike again if the underlying problems aren't solved.
Yeah, I think we're on the same page. I mean, that's exactly where I'm at. It makes it very difficult in this type of market, in this environment, to really almost get to, stuck in any type of opinion of what you think is going to happen. I mean, how could you? Like you said, the Fed is literally data dependent right now, right?
They have no idea what's going to happen in 2 months. That's why they didn't want the market to get too excited, because they don't even know what's going to happen.
And we could focus in on the energy crisis taking place. And like, it seems that both sides are kind of digging in over here. But that could change in an instant. In an instant, it's possible that you see Germany and other EU countries go back to Russia and work out some type of agreement with their tail between them. I mean, and that would drastically change the overall market environment rapidly, very quickly. And
would you think that that would be bullish, net bullish? And that's not a trick question, but
no, I
if
don't
that
think it's a trick
happened,
question at all. So when you say net bullish, you're talking about for risk on?
yeah, yeah, if Germany in the dead of October called and said, "Hey, we'll pay for gas in rubles, whatever you say, just give us the gas," is that bullish for risk assets?
Well, yeah, I think what would happen if that scenario were to take place is that you would see the price of natural gas obviously fall like off a cliff, right? And then ECB, who's now this week beginning like, we're going to get serious here about fighting inflation and tightening. They'll be able month over month to be like, look, we're winning. You know, we raised rates another 50 basis points, another coming off 25 basis points, and look at the price month over month coming down. And they're going to have like almost this like cherry picked place that they began off of and I think that you would see a bit of a repricing that we're seeing in the DXY right now with the euro making up 57% of that index. That, you know, forget long term. I'm talking about in, you know, 3 to 6 month period in front of us. I think that we might see the dollar come off a little bit, and I think that would absolutely help risk assets. So yeah, I think in the near term, and look,
I think you're right.
I can't look, you know, 30 to 90 days. That's really like, and 90 days is pushing my time horizon right now. And for a few months now, that's kind of the view that I've had. And I think it's the correct view. So it's difficult to say. There are so many moving pieces right now and so many potential events that could have such drastic impacts across the markets. Yeah. So we're talking.
Do you have a bias about whether the floor is in for Bitcoin? I realize I just cut you off there. Sorry.
No, I do. So I always have a bias, and because I have always have a bias, I've been spending 2022 really trying to be as aware of my bias as possible. And I don't think that you could prevent yourself from having a bias. Like I feel honestly, intuitively, that we each have a different bias when it comes to the Fed. And I think that it's almost, there's a lot of like almost places where we overlap each other. But if you move like 6 months from now or 4 or 5 months from now, I think that, you know, I think that we might each have a bias of what we think is going to happen. And you can't help that. You know, you have this information that you've taken in, and it helps form your own bias. But trying to fight, like, if I could understand my bias and just be aware of it, that's almost giving myself, let's say, a chance to be able to execute better, you know?
Does your bias tell you that the low is in for BTC?
So I cannot answer that in so much as that I could tell you, after we have this month's CPI on the 13th, I will have a much better idea of what I think the Fed's rate hike is going to be. And let's say it comes in not at 8.5%. Let's say it comes in at 8% or lower. At that point, I think that the Fed is hiking 50 basis points. And I think at that point, we're going to then see, now some people have called it a soft pivot, in so much that the degree of the rate hikes have changed from 75 basis points to 50. And that's okay. That's a good way to categorize it. But it would be a change in direction. It's not moving to a pause, right? But it's a lesser degree of hikes. And then if you continue to see headline inflation coming off, you know, November should probably be like a 25 basis point hike, right? And then, yeah, at that point, I could see a rally coming into the markets. I would say that in the equity markets and in Bitcoin, that there's a good chance that the June low holds. Now, adversely, if that print comes in above 8.5%, I think those lows are going in September.
Yeah, I think that's pretty much how I'm looking at it. And I appreciate that you didn't just immediately go, oh yeah, I'm pretty sure the low is in, that you actually, you kind of backed into it, which is the way that I also like to look at it, because it's hard to say that with any kind of equivocation, like any kind of confidence. Oh yeah, I think, I'd give it a 50% or I'd give it a 70% chance the low is in. There's just so many factors, and everything is data dependent. And I think that it is very dependent on the CPI print. I think, my gut, just based on the news, it just seems like it's probably going to continue cooling off a little bit in rate of change terms. I would give it a higher probability that it is a lower print and not a higher print. But
I
I
also think I'm cutting you off here.
No, go ahead.
I don't want to, but I also think that the Fed wants that. The Fed was not happy with Jerome Powell's press conference all of a sudden repricing itself so like quickly. The Fed, I think, wants to keep everyone kind of guessing what happens going forward. As much as they are data dependent, guessing themselves, like they don't want the market falling off a cliff, and not so much the price of equities, but we don't want to see the credit markets getting into any type of crisis situation, because that means that the Fed has to come in. From my view, that means that the Fed has to come in and respond with further balance sheet expansion and even QE purchases, and that's going to cause even a bigger mess than they're in. So I think they want to kind of drag out the next time they have to do that as far as possible, right? So they don't want the markets going straight up, because then they're not, slowing down the demand that's causing inflation, which is, aside from supply chains, one aspect that they have control over. So they don't want that. And I don't think they want like a disorderly market. So I think that like they would be good with data dependent September, October. And like, even if that means that I could foresee again, a low being put in the equity markets, Bitcoin, June, so long as the data continues to be favorable to give that. And then I think for me, I look forward into 2023 and I look at the state of the economy, and my bias gets in the way. For me, it's very worrisome. And for me, it gets very worrisome once you start seeing rate cuts come into the market, because they're not cutting rates because things are good. They're cutting rates because the economy needs it. And that's when things, maybe on the first rate cut, maybe the rally gets to extend a little further, but generally that's when things start getting bad. And I think that at that point, if like this is assuming the scenario that I'm just proposing here plays out, and at that point, depending on how much of a cushion you have off of that low, we could wind up taking out that June low in equity markets and Bitcoin and making a much lower low.
We don't want to do
much
that
longer, or not.
Yeah,
because in the 2000, no, go ahead.
No, I wanted to hear what you had to say. Sorry.
In the December 2018 risk market low, right? In the 2020 crisis, we didn't take out that low. Risk was able to rally enough that even under that type of severe dollar liquidity crisis, global lockdowns, that other low still held. That's also possible in 2023. That look, there's a lot of time between now and then, but I don't have the answers, right? But I want to be aware of all possibilities.
Yeah, what the market is able to do between now and when I think the wheels might actually come off the bus, depending on how high it's able to get, plays a big factor on whether or not it threatens like a complete collapse of market structure on whatever kind of downturn we have. Because my opinion, when I just look at the index, I look at the Dow Jones a lot. I know a lot of people look at the S&P. You can look at both of them, but the Dow Jones, I think it gives them a cleaner example of this. In the June lows, it pulled back perfectly to the pre-COVID highs and the 200-week moving average, and it hit them like perfectly. And when you just look at the market structure, that really, if that low is able to hold and the market's able to kind of develop beyond that and not just completely take it out from some bad CPI print, then I think that you can still make the case that the grand scheme parabolic structure of the market is still intact,
Right.
and that the greatest of all asset bubbles is not quite over yet. But I do think that if the core of my bias plays out in any kind of way over the next like year to year and a half, I do think that those levels will be threatened at some point, and that if they are to break, that the recovery would be far worse than anyone alive in markets now has ever experienced. Maybe it's like a 2008 kind of scenario. I'm not trying to make those kind of comparisons, but I just think from a market structure perspective, you don't want to lose those levels on a really basic TA level. And depending on how far we're able to get away from them over the next few months, if we can capture some upside in some way, even as it seems like the news cycle is just worse and worse, if we're able to capture some upside here, maybe we can get away from those levels. And maybe if we do have a bona fide recession next year, maybe we don't take that out and we can continue this fiat Ponzi a little bit longer.
I love the way that you illustrated that, and I actually hold the same bias. And so here's the thing, though, we could get a little more intricate. A lot of people kind of hold one of two biases, and that's right now, whether it's September, like we're going to be making a new low, and that low is going to continue likely for a year or two, and it's going to take a lot to damage to repair and for a while, and that could very well happen. And then other people think that the risk markets, including Bitcoin, are going to go new all-time highs and then crash, taking out these lows, and it's going to be a horrific crash. And those two are almost like, while either of them could happen, there could also be something in the middle, like maybe risk rallies right, and doesn't make a new all-time high. And then maybe risk takes out those lows or it doesn't, and I think that's where you need to live. You need to you can't be deterministic about what you think is going to happen. Nevertheless, 90 days from now, forget 9 months from now. And that could really kind of box you into a corner or lock you into just a place of weakness rather than being in a,
I think so. Especially when you see how distended the market is, and you look back over the last century of data, and there's only a couple of times that it's ever looked like that. So the average analyst doesn't have a lot of analogs to draw off of, and they're all fucking horrendous, excuse my language. And so I can see where that bias comes from, and I'll admit, like, some percentage of my bias is that doomsday scenario of new high and new low.
Right.
It's a percentage outcome, though, right? Like, it's not locked in. None of these scenarios are locked in, and I do think there's a very possible scenario in the middle where the market is not able to break out of this kind of established range that we are in, where we can't get any higher than at the best of times, and we don't go any lower than the worst of times of June. That's also possible. And when you look at like the S&P in the 2000 decade, from the tech bubble to the great financial crisis, for 10 years, it didn't make a new high, right? It just made a sideways kind of consolidation formation with two bubble peaks, and it wasn't until about 2013 that the market actually made a new high. So that is a possible scenario too.
Absolutely. And I think, at first I thought I was the only one who thought maybe sometime this year we're actually able to rally, and then even if we're able to make it to new all-time highs, like next year could be really difficult. But I think a lot of people now actually embrace that as well. So maybe max pain is that happens, but then if we keep going, that's what I think it might be with the least amount of people expect. But that does bring into question, though, I think that everyone's view of what's taking place now is starting to evolve or change, and including the amount of liquidity out there, which I kind of believe Powell when he feels like the economy could take the tightening. And I know that Arthur Hayes provided a really good insight recently on his Medium article, and through the treasury holdings and through the repo market of giving a different spin on has that changed your view at all?
No, not specifically. I liked that article. I made that model because I wanted to look at it, and I think the argument made for he made a like a liquidity index in that article, and it showed like the repo market, the Treasury General account, a couple of things. They were all put together to represent like dollar liquidity. I think it's an interesting idea. It's really hard to know though, like what all these different effects are going to do in this environment, right? Because like the economic environment looks a lot like the 70s in the terms of like the commodity shock, the energy crisis. It looks like, and in the inflation problem, it looks like the 70s. And the 70s was another example of the market just going sideways for like a decade. But at the same time, we've got all this, to use your word, liquidity that's been shoved into the markets over the last couple of years. Not all of it has been withdrawn. A lot of it's still kind of sloshing around in different places. Like the reverse repo has $2.5 trillion just kind of floating around in it. That could leave at any moment if the Fed just decided to lower the rate by like half a tick, right? All of a sudden that money goes into the economy somewhere. So like we're that close to having more liquidity in there, but it's being held back. And you know, you and I haven't even mentioned quantitative tightening this whole conversation, but that's accelerating this month, right? And that's not an environment that we've seen outside of like late 2018, early 2019, when the markets didn't like that very much. So I'm not really sure how to add all these pieces into a formula here, because I don't know that they all play such a large role on market health, and it's really hard to know how people evaluate those things when they're applying it to price action.
I have such a bias too when it comes to quantitative tightening, and my bias is that the rate hiking cycle supersedes it, and it's unfortunate because there's only one cycle of quantitative tightening to go off of, but it's all we have. And in that cycle, I saw that it was when the last rate hike came in, that's when risk rallied, and it rallied another 9 months as quantitative tightening was taking place. So I get stuck on that. And I don't know if that's going to be an asset for this cycle or a detriment, because the odds of them being the same again are who knows? You could flip a coin. You don't know. But I do know right now they are raising rates, and with QT beginning to pick up, that doesn't sound like a good environment. And that's one that we saw in that last fourth quarter 2018. We saw a huge correction across risk. And for sure, that's what we could be headed towards right now, as we are looking at, you know, rates continuing to rise and quantitative tightening picking up. So
I was surprised that they were able to raise rates as quickly as they were, and that the market, for its part, actually seems to digest it. Like we could be in a lot worse situation than just 20% down on the S&P, considering how tightly or how quickly they raised the terminal rate, and considering the indebtedness in the system, how many zombie companies there are. You know, I think it's like 15 or 17% of the market are unprofitable companies that can't raise debt. It's just, I've been amazed that we haven't had more businesses going out, more hedge funds cratering. It seems like the market has put up with this a lot better than I thought they would, which makes me almost wonder if there's like a morsel of truth, which is something you said a few minutes ago, that maybe Powell was partially right, that the economy can kind of take this, in the sense that we could be down 50%, but we're not, you know, we meaning equities, obviously Bitcoin is.
I don't think that the Fed also expected the conflict between Russia and the Ukraine to happen in March, when they began raising rates. And under that type of stress too, under the current energy crisis that's taking place, specifically in Europe, I mean, it seems, and then I wonder, you know, is it because of the weakness that you're seeing in Europe that a lot of these funds are focusing in the markets over there, and is the U.S. actually providing a safe haven? And I mean, I think the more we talk, the more I realize what unprecedented and confusing times these are in, and it's very difficult to really form any type of midterm type bias, right? Is that correct?
It is. I feel that way. I feel that way very much, and I struggle with that with my audience as well, which has grown a lot in the last year. Is I don't I want to be able to express like how I want to be able to express like some kind of signal in all of this noise, but it can be very difficult to do that because there are so many different plates spinning at the same time, you know?
Yeah, absolutely. I don't think we could take it any further. I mean, we've looked at everything that we're currently facing, and then it almost comes back to those words that we've repeated so often: data dependent. And I don't think that we could look beyond even the upcoming CPI print. Like, that is right now the most important piece of data that will be coming into the markets. That's going to be followed by, FOMC. And then in between, we get to look at all these manufacturing reports and PMIs.
And
obviously,
next month is earnings.
Yeah. And that's
Q3 earnings is next month.
Surprise. Q2 earnings was a surprise. And if Q3 are also a surprise to the upside, I mean, that makes things Jordan, more difficult.
Yeah, sorry, bud. One thing that I have in my mind that I'm kind of watching for that is not necessarily playing into I'm trying not to let it play into my bias, but it's something that plays out through history. Is that when we have these inflationary spikes, I mean, going back all of the 20th century, we have these periods where CPI is 5% or higher. Usually, when we have these regimes, earnings come down significantly at the same time that unemployment is rising, right? And neither of those two things have happened, even though we're still in the inflationary regime, like a 40-year high in inflation. That sequence of events has not yet occurred. Earnings have not priced in what the other aspects of the economy are starting to price in. And that's something that I'm waiting for. I don't know if it's Q3. I don't know if it's Q4. I thought we were going to have it happen in Q2, and we got that news about Walmart and Target and some of those big box retailers having just explosive amounts of inventory. Usually you get flash sales and then you get cost cutting measures when the flash sales don't, bring you back to profitability. That didn't really seem to have that same effect. They were able to get through that problem and it didn't ripple into the rest of the economy. You got all these layoff announcements, but it hasn't been anything of the scale that you normally see in like a real recession. And so there's a stickiness going on that in the labor market, in earnings, that it might allow this to take more months to play out. I think that there's other shoes to drop, and I'm not sure when they do, if they do, how bad they fall. But that earnings piece is one that's been a little puzzling for me.
And then there's one other thing we haven't mentioned, that's China. And it's a rather important piece of this puzzle.
We need to have a big bullet list of like all the things we need to talk about. We need like 30 things on the list, and we just go down the list.
Have it on the right side being highlighted as we go down the list.
A little rundown. Mm-hmm.
And we've seen this enormous devaluation of the yuan taking place, which historically, or I could say over the last 2 cycles or 7 years, has not been good for risk. However, by the time the yuan finishes devaluing, risk is usually trading higher than when the yuan begins devaluing. Wherever risk is, or the equity markets, by the time it finishes, you're seeing risk trade higher. And then as the yuan begins appreciating, well, risk really starts melting up, like moving powerful. And so the reason I just kind of give that brief description is because right now we're seeing the Chinese going through a crisis of their own. We're seeing the yuan under strong devaluation, which is probably related also to the Japanese yuan being devalued and them trying to stay competitive. But at the same time, we are going to be seeing some type of response from China, I assume, some type of stimulation to their economy. And I do think that's going to have some type of effect overall. And if indeed we start seeing sooner than later some type of stimulative measures coming out from China, that's going to affect the global markets, right? And I think that what we have been seeing is China actually stepping back. They're having their zero COVID policy lockdowns. It's caused a big lessening of demand in the energy markets,
Mhm.
right? And if that demand starts returning, is that going to be a net positive or actually a negative? Because we might start seeing, obviously, specifically crude oil prices start rising sharply, and that's we're in a bit of a conundrum here, I think, is what I'm getting at.
We are, and it seemed like China's cycle is not aligned with the West's, like their economic cycle. They were kind of going through a tightening period last year. They were cracking down on a lot of tech. You really started to see the ripples coming out with what was going on with Evergrande. That was like last September. It was a year ago. And they were going through that period when our central bank was still saying inflation was transitory and they weren't talking about raising rates yet. And so I think that they've been a little off sides, and maybe like you said, they're getting to a place now where they're talking about stimulus. I think I saw they just passed some huge loan packaging for businesses, some like $70 billion worth of loans they're going to try to get out. So they're trying to stimulate their economy now after a period of tightening. But because of all of these resource constraints, I wonder if they're, if they actually start kind of moving the needle towards the positive while the rest of us are going through this energy crisis. I wonder what that does to prices. Certainly, I don't know what the answer is.
Yeah. So you know what, and that's the beauty of it. Like when we came to start talking about China, you know what, nothing there really came up that was signal, right? And here's the thing: you have to be able to view all different aspects, across the markets, and often you go down these tangents and it doesn't lead to anything at that particular time, but you still need to make those journeys, and you still need to be able to view those things, even if right now it's not really something that's, this is something that might in the future really come into play, but maybe not right now. And
making that determination is part of the analysis. Yeah, it's part of the process.
Yeah,
exactly.
Yeah. It's interesting, and I really feel like the greatest takeaway for me today was first of all, I mean, beyond the absolute pleasure of being able to talk markets with someone like yourself, is that we're really, rightfully so, in a similar place where it's impossible to make these determinations at this point. Look, we're not in a Goldilocks period. You can't just lock yourself in, and we are in uncertain times, and a lot of that tightening is already taking place. And again, the right time to position for that was going back into late 2021, right? And a lot of people right now in the summer of 2022 have become almost like, you should be long the dollar, long commodities, short risk, and okay, but you're telling me something that has already largely played out, right? And we want to be forward looking, forward thinking. And I think it's okay to be in a place where you can't really do that right now. And I think that you need to be really more almost neutral and be looking at what takes place over the coming weeks and months ahead to solidify and determine your view a little bit further. Does that make sense?
It does make sense. And something that I always try to remind myself about is that assessing the market and deciding that there is no trade is trading, right? Like you're making a decision, you're participating in the market, you're deciding if there is a risk reward opportunity that fits within a strategy you understand, and making the determination that you don't see one, if that's your determination, is trading, and it is participating. And sometimes it can feel like you're not doing something. You see all these other people, I'm shorting this, I'm doing this, I went 3x long oil at the bottom, like whatever. Different people see different opportunities. I've found this market pretty hard to read the last couple of months. So I'm just happy that I'm sitting in my spot BTC in cash and I'm not doing anything other than just accumulating for the long term, because I don't personally see a lot of opportunities here, but for those who do, this is probably the most challenging market conditions that anyone alive today has ever dealt with, I would say.
Absolutely. And for sure. there are so many different ways to get your thoughts, right? I mean, I know that there's on YouTube, Alpha Beta Soup, and then your Twitter is also, it's such high signal. I feel like
Thank
we
you.
live in this world where there is a lot of noise, and that noise is really right now these like both sides of the spectrum of this, like, you know, highly deterministic views. That's not where you want to be. You want to be in the middle right now, having conversations from all ends, trying to figure it out. And that happens on your Twitter feed, right? So I like, look, TXMC, I couldn't tell people, look, you need to follow you on Twitter or you need to follow on YouTube. I think you need to do both, you know? And
Thank you.
yeah, you're really
I really enjoy talking with you as well. Like, you're one of the people who regularly engages with me in my threads. Not everyone does that. And so I appreciate our discourse because I learn a lot as well. And I've learned a ton in this conversation here with you. I'm glad that you had me on.
yeah, that's just natural. I feel like I have the most to learn from things that you're sharing, and I want to just participate in those type of discussions. And so I'm just naturally drawn there, and to be able to now take it further here, and this was a great conversation beyond my expectations. Thanks for making the time here to do that.
I appreciate it. I'm glad to talk. And if you ever want to do it again, just let me know, bud.
For sure. Once we have a little bit more data in front of us, we'll be able to reassess.
Yeah, absolutely.
All right. Thanks, brother. I appreciate it.
Thank you.